Welcome back to Investing and Trading Live, sponsored by Online Trading Academy. If you're just tuning in, we were talking about some different things that are happening in the markets. We talked about Meta, how it dropped down about 64%, shot up 210% from the lows in the last couple of years here. So some great opportunities with really wealth creation in the markets. And that's what it's all about with the stock market. Is it's a great asset for wealth creation, but not always at the right time. When is the right time to be able to buy stocks? When is the right time to buy something and have the opportunity for it to continue to go at the very highs or after it's dropped? And that's where supply and demand comes into play, which is buyers and sellers, and it's how the institutions move the markets. If you're just tuning in, you missed tickets for the class that we do here locally. We actually have local investing classes for people just like you to come in to see what the markets, how they work, different strategies, techniques, whether you're looking for an income strategy or a wealth strategy in the market. We have these local classes here in Bloomington. You can just text the word investing to the number 210-210 for 2 seats for this class. Most people bring their spouse in, so I encourage that. Bring your spouse with you. If you do your financial decisions together, have a little fun with this. To come into one of these classes and see how the markets work and what might be an opportunity for you and your family to do better in the future. It's all about making better choices. Text the word investing to the number 210-210 for 2 seats. When you do that, you're going to get a text right back. There's going to be a link in that text. It'll say, "Welcome to Investing and Trading Live," the name of the show, and then it'll have that link so you can pick your own date in there. We do these classes during the weekdays and on the weekends, so pretty much anybody can attend. So, Al, you were talking about the, what do you call it, the Magnificent Seven?
Magnificent Seven.
Magnificent Seven. That's a tough word to say. What's that other word that we used to talk about? You remember what that was? Our memories are gone almost. There's a word that we just I couldn't say.
Yeah, I can't remember what it was. But once you mispronounce a word, then it sticks in your mind, and you keep mispronouncing it.
Yeah, but those magnificent Magnificent Seven.
There you go.
It almost used to be the Fangs. It used to be called the Fangs.
That's right. Yeah.
And so the names are changing as well, which is pretty interesting. You were talking about Meta. You also talked about Apple.
I did.
And Online Trading Academy has something called OTA picks that we like to look at with different opportunities, and it's really, think of it as, we're teaching you how to fish, teaching you how to fish while you're learning. Boy, I'm just I'm tongue-tied today.
Instead of giving you a fish to eat, we're teaching you how to fish so you don't have to worry about having someone give you one.
You get the point, I think. But it's opportunities for people that are with Online Trading Academy to see different supply and demand zones, areas of opportunity where we have odds in our favor. And that's what it's all about. Mm-hmm. Put odds in our favor to make smart investing decisions. And we have a potential area in Apple around the 175, 70, 174, 80 area. It's a range that we're looking at where there's potential buyers coming in there, which means it's where we want to jump along with them. But we have to put our own risk management parameters on there, our protective stops, and our targets. So it's not just, don't just go buy that. You need a plan to do that. And that's what we teach and talk about in these investing classes that we do here at the Academy is how to have a plan for your entry point and your exit point in the market. So with Apple having an opportunity here, will this continue to go up from this demand? Who knows? But if it's in your plan, if it's in your strategy, you have to take those opportunities. Are they going to be right every time? No. That's why you have small risk and much higher reward in the financial markets. And I think a lot of people don't really understand that. So I want you to explain that a little bit because we have a small area of interest on Apple. Mm-hmm. Now, rather than just buying and hoping it goes up, why is it so imperative to keep that risk small, comfortable, so you can have the consistency but also build the confidence to do that and then have the reward much higher? And then do you have to be right 50, 60% of the time to make this work?
No. Well, first of all, let me comment on that. No, you don't have to be right 50 or 60% of the time. It's one of the only things you can do, I call it professionally, where you can be right only maybe 40% of the time.
Ooh, I think I'm going to correct you there. You can be a weatherman, and you can be wrong almost every time.
which they typically are. You could give the same forecast every day, and you'd be right about half the time.
But they still have a job, right? Yeah.
But who else can do that? Can a surgeon be right only 40% of the time?
Can an accountant be right all the time?
Can a pilot be right only?
Can in construction, can you be right every time?
No, absolutely not. Yeah. But you can, as a trader, you can be right only 40, 50% of the time. Most of the pros out there are very happy if they're right 40 to 60% of the time. How can they be profitable if they're maybe even losing more than they're winning? It's because they pay attention to the right ratio, which is your reward to risk ratio. Just to keep it simple, it's just you need to win more, you need to make more than you lose. That's what keeps you successful as a trader. The first thing you have to learn to be successful, we feel, and this is how we teach, is to learn how, I'm going to say how to lose, but it's really how not to lose. We teach you how to look at a trade. First of all, understand what the potential risk is and then control it. Like everything else you do in your life. When you cross the street, you look both directions. Maybe you wait for the light to turn to walk instead of don't walk. That's controlling risk. When you drive your car, you put a seatbelt on. You stop when you come to a red light. All of those things you do to make sure you stay alive and you stay healthy.
Just to kind of give an example of that as well, with having much bigger wins than losses. We talked about it. We were singing earlier, and there's that song, 1 step forward and 2 steps back. But you have to have one big leap and then 2 little steps back. Those would be small losses to get your balance again, and then another big leap. So that's how you have consistency in the markets.
Yeah, you're not going to win all the time, but the way that you stay alive as a trader or investor is not to lose big. You'll have small losses, that's fine, and some of the small wins will offset that. But if you eliminate the big losses, what's left? It's the big wins, and those will come occasionally, enough if you're using the right process, so overall you have a great opportunity of being successful. And that process, think about this. If you're going to let's say you get some money, you inherit some money and you want to invest it. How do you decide what to invest in, and how do you decide what you're going to pay for something? Most people just say, well, here's a good company, I'm going to invest some money in this. So they will buy stock at whatever price it happens to be at that time. That's almost a guaranteed way for you to not do well as a trader or investor. There will always be a point at which a stock has a price that is truly valued, where it's valued properly, and where you have your risk controlled with the proper way of identifying what a profit is. And that's the key. You want to keep your risk low and your profits high. You do that by following a process that gives you a reason to buy something at a certain price and a reason to not buy something. We've mentioned this before. You can have the best company in the world, but the price of the stock can be so high that at this point in time, it's not a good investment. So it's not just what you're investing in. Is this the right time to do it? And is there a right price for you to get into that gives you an opportunity to have what we consider a quality trade? That's low risk, high reward, and the highest probability of it working in your favor.
Yeah, I like that. When you teach those investing classes, you really illustrate that on a price chart, because we can talk about it all we want on the radio. You're not going to understand it fully, which is totally fine. That's why we have these investing classes. So when you explain that in those investing classes, you're illustrating that because we're visual learners. I think most people are visual learners, and that's how we train and teach. Visual learning, so that way you can see it done, and then you can do it. That's what it's all about, and then building the skill and practicing. So if you want to come to one of these classes and be shown how to do some of this stuff, we have a physical academy. We have a state-of-the-art academy here in Bloomington, right off 494, and we have classes where we've taught thousands, just like you, how to make smart investing decisions. So text the word investing to the number 210 right now for 2 seats for this class. You get a text back with a link to pick your own date. Text the word investing to the number 210. So we were talking about Apple, Alan. I want you to break something down here. Keep it real simple, and I know we'll show it during these investing classes, but keep it simple. We were talking about Apple, and let's just say an investor wants to buy Apple. We were talking around, we'll say 175 as an example. Okay, say an investor wants to buy 100 shares of that. You need physically $17,500 to do that, because to buy 100 shares, you need that capital to purchase that stock. So you have we'll just say $17,000 tied up where you can't do anything with it. And if you get a $5 move in that stock, which sounds like a decent move, you only make $500. So really, that risk is almost $17,000 because it potentially could go to zero. Will it? I hope not, but it's possible. But you have to put up so much capital for such a small gain in the market. That being said, we have other markets that have leverage, which means you can use much less capital. I want you to talk about options here for a second, because as an example, to use options with Apple, do you really need that $17,000 to purchase Apple?
No, you don't. And the reason that people trade options is that, and you mentioned, have one position in Apple is over $17,000. That's only one position. You never want to only have one position. So for a lot of people, that keeps them out of the stock market. Well, you can still participate in companies that have high prices, like Apple, using a strategy or an asset called options. Options, it's a contract that you trade on an underlying, on something like a stock. And each option contract controls 100 shares. So if you want to control the movement of and the benefit of 100 shares of Apple stock, and you don't want to put $17,000 into it, you can use an option. And there's a number of different options. There's different what we call strike prices, different expiration dates. Those things we will teach you. But you could, for example, have an option strategy on Apple where it maybe only costs you $500 or $400 or $600. You're still participating in the movement of that 100 shares of stock, but your full investment now is, say, $500. If Apple closes their doors tomorrow, if there's a catastrophe, the stockholder is going to lose $17,000. The option holder will only lose that $500. That's the maximum you can lose. So you're entering that trade with a much lower risk to begin with. But if Apple, let's say Apple goes up 10%, well, the option's probably going to be up somewhere between 100 to 200%. So not only do you have lower risk, but your potential return, your rate of return is significantly higher.
Yeah. So just to kind of go a little deeper, and we're not going to, we'll illustrate this in the investing class, but here's an example of the same exact trade, okay, with options. So if an investor in the same spot, the $175, it's called buying a call is what you would do, right? That in this same example, it would cost that investor only $1,360. I'm looking at an options chain right now. So at this current time of doing the show, it would be $1,360. That fluctuates, but not a lot, but it does fluctuate a little bit, which is much less capital. So rather than having $17,500 in there, you could only have $1,300 for that same 100 shares.
Right. And the great thing about options, though, is with the number of options that are available on that options chain, you can decide how much you want to pay. The one you just mentioned was $1,300. Well, if you don't have $1,300, there would be options where you can do it for under $1,000, maybe that $500, as I mentioned. Yeah, it depends on the option strategy.
There's another one here for $500.
Sure. Yeah.
So you choose that.
You choose that.
Yep.
But your potential, the rate of return that you have is significantly more. It just allows more people to participate in stocks that are high priced that would normally keep you out of the market, but it also lowers the risk.
Yeah, it also brings more investors into the market because it allows people to get started with much less capital. If you're listening right now, and let's just say you even do have 17 grand right now, why put all that in the market and then you can't do anything else with it?
Sure.
Use less, like in this example, $1,300. If that was the strike price that you wanted to get into, it allows you to get into the market and do multiple positions if you want to.
Exactly. Yeah. Maybe instead of Apple, you do some Apple, you do some Meta, you do some Google. You can spread that out. You can be diversified with a much smaller upfront.
Exactly.
Kind of out-of-pocket
and I know
cost.
we're throwing terminology here at you guys today. Don't worry if you don't understand it. You're probably driving right now and looking at your sweetheart and saying, honey, what are they talking about? Well, if you want to understand it, come to one of these investing classes. That's why we illustrate it. We show you. Most people are hands-on learners and visual. That's why we have these investing classes. If you want to come see some of these different opportunities to use less capital in the markets by using leverage assets, text the word investing to the number 210 right now for 2 seats. Text investing to the number 210. When you do that, you'll get a text back with a link to our landing page. and you can pick your own date during the weekdays or the weekend. Coming up next, we're going to continue the discussion about how to use leverage with retirement accounts, using less capital, and protecting those hard-earned portfolios that you've been building up all your life. We'll be right back.